The most important thing, Part 3, the invisible price of risk. In Part 2, we saw that in the market, everyone sees the price, but not everyone understands the value. That very invisible gap many times gives an investor an opportunity and many times pulls them into a trap. We saw that a good company is not always a good investment. If the price is packed with expectations, even a small disappointment can turn into a big loss. But the question was still incomplete. An investor feels that he has caught a bargain. The price is low, the story is logical, and the value is looking attractive on the screen. Still, news comes at night and his confidence shakes. A fear arises in his mind. If the price is right and the value is right, how can a loss still happen? This is the real mystery of Part 3, because risk many times stays hidden behind numbers. Part 2 had shown the war between price and value. Part 3 tells where the real blow lands in this war. Risk does not arise when everyone is afraid. Risk increases when everyone becomes carefree. Howard Marks says that before controlling risk, it is necessary to recognize it. But this is the hardest step, because everyone sees risk after the loss happens, very few people see it before. Just like after rain, everyone can say that the clouds were heavy. But a good investor has to read the direction of the wind before the storm. The problem is that in the market, the clouds are many times golden in color. An ordinary investor links risk with a fall in price. The stock fell 20%, so risk became visible. But Marx's point is different. Risk is not a fall in price, it is the possibility of permanent loss. Volatility can be uncomfortable, but not every volatility is dangerous. The real danger is when you have bought an asset whose value turns out to be far less than your thinking, and recovery remains merely hope. Right here, the most famous myth breaks. People say, high risk means high return. Hearing this line feels powerful, but a half-truth many times is more dangerous than a complete mistake. If high risk really guaranteed a high return, then it would not be risk at all. Risk means the outcome is uncertain. The return can be very good, average, and sometimes painful too. The real mark of a high-risk investment is that its result can be in a wide range. The possibility on the upside shines, but the possibility on the downside often gets hidden in the presentation. To the crowd, risk feels low when recent returns have been good. The stock is going up, the fund is outperforming, and every investor is saying, see, this turned out to be safe. However, this can be an inverted signal. A rising price often does not reduce risk, it increases it. Because the higher the price goes, the thinner the margin of safety becomes. A company becomes popular. Its name is in every report, its chart is in every video, and every investor feels that the future is clear. But clarity many times is an illusion of the crowd. A high price does not always mean an immediate crash. But a high price means that the future will have to be more perfect, and the future is rarely perfect. Price and value are the first radar of risk. If the price is far above value, risk can increase. If the price is below value, protection can be received, but the story is not that simple. Because a low price does not give safety on its own. A stock can be cheap also, because the business is genuinely breaking down. A falling price is sometimes a bargain and sometimes a warning signal. This is what a value trap is. The investor thinks that the stock is cheap, but from the inside, earnings are weak, debt is heavy, customers are moving away, and management is only selling excuses. On the other hand, even a stock with a high price is not always worth avoiding. Some businesses are genuinely durable. But in them too, the risk is that you might end up paying too high a price today for the future. Recognizing risk means asking, for this investment to prove right, what all needs to go right? The more conditions required, the more fragility might be hidden inside. Now look at the story of global funds. Many investors are told that spreading across the world will reduce risk. There is logic in the statement but no guarantee. In times of crisis, many markets can fall together. The very diversification that the investor was considering a shield sometimes turns out to be merely the same storm with different doors. It is said that the fund has big companies, so risk is low. But a big name is not safety. Safety comes from price, value, concentration, and expectations. Technology and digital calculations have also created a new illusion. People feel that better screens, faster data, and smart tools have reduced risk. But the tool can be smart, while the user can still be emotional. Today, charts get created quickly, orders get executed instantly, and analysis shows up in seconds. But speed does not create wisdom. Many times speed only accelerates mistakes. Risk never ends, it merely changes form. If you reduce single stock risk, then perhaps currency risk comes up. If you reduce currency risk, then liquidity risk comes to the forefront. Leverage is a clear example of this. The investor thinks that the stock is strong, so he will increase return using borrowed money. But now risk has moved out of the stock into loan, interest, and forced selling. Many products come in the name of protection. Options, structured products, hedges, complex funds. Useful in the right hands, but if used without understanding even protection can become confusion. Right here, the role of fear changes. We consider fear a weakness, but in investing, the right fear is like a seat belt. It does not stop speed, but it can save a life in a crash. The investor who does not feel fear at all is many times the most vulnerable. Because there is a very thin line between fearlessness and carelessness. A smart investor does not run away from fear. He interrogates fear. He asks, what am I afraid of, and is this fear based on facts or merely market noise? Too much fear is also a problem. It keeps you away from every opportunity. But having no fear at all is even more dangerous, because then you start taking price, leverage, and uncertainty lightly. The most dangerous phrase in the market is, this time it is different. In every bubble, this line comes with some new name or another. Sometimes technology, sometimes liquidity, sometimes global growth, sometimes new economy. When people start accepting less compensation in return for risk, risk begins to increase. Because an investor needs extra return to take risk. If there is no extra return, the deal is weak. This is what risk premium means. If you take uncertainty, you need a reward as well. But when the crowd is excited, it reduces the demand for a reward. This shows up clearly in bonds and loans. When lenders start giving cheap money even to risky borrowers, the system looks calm from the outside, but risk begins to accumulate on the inside. The same happens in stocks as well. Valuations get stretched in popular sectors. Everyone is buying the same story of growth, and no one is asking where the downside is hidden. Real estate, startup investing, crypto, or hot stocks, the asset can be anything. The pattern is often the same. First comes the story, then comes the crowd, then discipline starts getting left behind. Recognizing risk is not predicting the future. It is not saying that a crash will come tomorrow. It is seeing that conditions are being formed where, if a crash comes, the damage will be large. Looking at dry grass in the forest, you are not saying that a fire will catch today. You are merely understanding that if a spark comes, the speed of spreading will be very fast. A market boom is also like this. Prices are high, leverage is high, confidence is high, and doubt is low. Everything looks smooth, but fragility is quietly increasing. Liquidity also deceives in this same way. On normal days, it feels like you can sell anytime. But in a panic, buyers disappear, and the exit door suddenly becomes small. The same danger exists in a crowded trade. If everyone is sitting in the same idea, the problem becomes not the quality of the idea, but the capacity of the exit. If everyone wants to leave together, the price can break. Therefore, Marks' most unsettling lesson is that risk is highest when people believe that risk is low. A calm market many times is not safe but overconfident. And when can risk be lowest? Many times when people are scared, prices are low, and bad news has already come into the price. Fear sometimes becomes the beginning of safety. This contradiction confuses new investors. What feels comfortable can be risky. What feels scary can be attractive. But buying merely looking at fear is not wisdom either. The investor from Part 2 now looks at that same stock again. The business is good, but the price is demanding perfection. For the first time, he understands that risk is not just in the company, but in expectations as well. Then he looks at a neglected stock. News is bad, people are selling, price is down, but the balance sheet is strong, cash flow is saved, and the market has perhaps given too much punishment. Now he does not buy immediately. He creates scenarios. What will happen if the business recovers? What will happen if it stays flat? If it worsens further, how much loss can happen? The best case gives him excitement, but the worst case gives him reality. This difference creates maturity. An amateur gets hypnotized by the upside. An investor converses with the downside. He asks, how much is the upside and how much is the downside? If the upside is small and the downside is large, even a popular story can be rejected. If the downside is protected, even a boring idea can become interesting. Then he searches for a margin of safety. Not merely because he wants more return, but because he wants to save himself from his own mistake. Humility here becomes protection. He reads the balance sheet. How much is the debt? How much is the cash? Will the business survive in a recession or not? Because risk is hidden not just in price but in survival capacity as well. Then comes the most personal question. If this stock goes against me, will I be able to hold emotionally? Because investment risk is not just in the asset, but in the investor's behavior as well. Many people say long term, but panic sell in a 15% fall. Their strategy was not weak, their emotional capacity was untested. Risk was not in their portfolio, but in their patience. This is the major turning point of Part 3. Risk is not an outside thing. Risk is in the market, in the product, in the price, and inside you as well. Recognizing risk is not pessimism. It is respecting uncertainty. It is believing that the future is unknowable, but walking blind is not necessary. This is the satisfying payoff of Part 3. Low risk and high return are not impossible, but they are found when price protects, the crowd is fearful, and analysis is honest. However, recognizing risk is not the final step yet. You have seen the smoke, seen the dry forest, and seen the exit door as well. Now the question is, if the fire catches, how will you survive? In Part 4, the story will go toward controlling risk. Because a great investor does not avoid every risk. He chooses which risk to take, which to leave, and which demands a price. Right here stands the next big question. Is real smartness in earning more returns, or in avoiding that one loss which can wipe out years of earnings in a single blow?
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.